Welcome to another 5 tips video. This time we're looking at 5 tips for investing in the stock market. Disclaimer, as always, I'm not a licensed professional, at least in the financial world, and this video is for entertainment purposes only, blah, blah, blah. Again, I like to have this for entertainment purposes, but I hope you're also able to take some real advice out of this. There's a lot of good detail in here, so really, I hope this does help you, even though we say it's for entertainment purposes. So jumping into this, number 5, having a base of index funds. I think this is important, whether or not you're jumping in the stock market basically to invest all in index funds, or whether you're going to actually buy individual stocks. I think having that base of index funds is very important. It's discretionary for how many index funds you want to have. I like the VTI, the Vanguard Total Market, the VXUS, Vanguard International, and VNQ, the Vanguard REIT Real Estate Fund. One note on the VNQ, if you're holding that in a taxable account, just be aware that you'll be taxed instead of as dividend income, which gets the preferred rates. It'll be taxed as real estate income, which would be kind of at the ordinary income rate, whatever your tax bracket is. So what you want to, at an ideal situation, what you want to do there is have that VNQ in a tax-deferred or tax-exempt account, such as a 401k or an IRA. But if it's in a taxable account, it's really not the end of the world. Having index funds also allows you to get invested in a broad base. So again, instead of just buying an individual stock, the VTI is like over 3,000 stocks. So you're getting that exposure basically to the total market for the low cost of being able to invest basically in however many shares of the index fund you want, instead of having to buy all 3,000 of those companies. If you are going to invest in individual stocks, I prefer personally dividend paying stocks, and I prefer only using extra money to invest in individual stocks. So my personal scenario, 401k and IRAs are in index funds, and then my taxable investments, which is my extra money, I put them in individual stocks, individual dividend paying stocks. I can make a video on dividend paying stocks and the benefits of having a dividend paying stock, but I really do prefer dividend payers. Number 4, researching the financials. So you have your income statement, your balance sheet, and your statement of cash flows. A couple items I really like to focus on. These are balance sheet items: goodwill, intangibles, book value, or debt, and then ultimately book value. So goodwill is the difference between purchase price when acquiring a company and the net assets that you're acquiring. So although this does appear as an asset, you really want to be careful, because another way to look at goodwill, can be how much did a company overpay when buying another company. So you really want to make sure that the goodwill amount, if there is a goodwill amount, that it's not making up a high percentage of the book value, which is essentially the equity the company has. So another one, intangibles. Those are not physical assets. They include more patents, trademark, copyrights. In certain situations, they can be income producing, but in other situations, they're not. They're more of just protective assets. So again, what I like to do personally when I'm looking at a company's financials is just back out the goodwill and the intangibles number and kind of see what the equity would be without those amounts. On the debt side, so it's very hard to go bankrupt with no debt. If you have essentially any sales and you're making any margin and you don't have debt, and nobody's knocking down your door for payments, it's very hard to go bankrupt. It is okay if it's not excessive, especially in this environment, since the interest rates are so low. You're going to see companies taking on debt because they're getting it at historically low rates. So if they do have some debt, that's okay, but we don't want companies to have excessive debt because that could be signs of trouble down the line. And then the last point, like I said, book value, which is essentially the difference between your assets and liabilities, also known as equity. I like to look at book value if I were to back out the goodwill and the intangibles amount, because I feel that gives me more true book value. Another thing is looking at book value to the actual market capitalization. So whatever the equity amount is, and again, equity, in my case, minus goodwill and intangibles, comparing that to the market capitalization, which is the price of the stock times the number of shares, and seeing what multiple you're paying. The lower the multiple, the closer the book value is to the market capitalization, the less of a premium you're paying for the stock, which could also be indicative of the market basically saying that the future prospects for that stock, in terms of the market's view, general market's view, are not bright. Whereas a lot of like the tech companies, like the Amazons and the Netflix, you're going to pay a high multiple. You're going to pay, the market capitalization far exceeds the book value of the company, because the thought is that these companies have brighter futures, more room to grow, really. Number 3, statement of cash flows. Cash does not lie. GAAP accounting, I won't say it lies, but it's not perfect. Especially if the company pays a dividend, you really want to be looking at the cash flow. I like to focus on cash flow from operations. See what the day-to-day activity, the normal activity of the company, what kind of cash that brings in, and then compare that to the dividend payment, which you'll see. So basically, cash flow from operations compared to dividend payment, which is under the financing activities. I like to use a threshold of about 30 to 40%, if not lower. Essentially, what that tells me is that the amount of dividend that they're paying is sustainable, even if they just were to maintain their current the level of operations and the cash they're bringing in from operations. If you run into a situation where the dividend payment is more than the cash flow from operations, and then especially if you look at the balance sheet and see how much cash they have, and they have, say, not enough cash to pay out even a full year's worth of dividends, then you run a high risk of the dividend being cut, or the company going out and raising debt to fund their dividend, which in the short term you might get away with, but in the long term you're just really asking for trouble there. Number 2, the PE ratio, the price to earnings ratio. So this is comparing the price of the stock to the earnings of the stock. So what you're going to see here is generally the higher ones are instances where the market believes future earnings will be strong, more of what the market thinks are high growth. So your Amazons, your Netflix are generally the ones with the more tech companies in general with the higher PE ratios. The lower PE ratio is typically indicative of the market believing that future earnings will be weaker and the company will experience low growth. You look at eBay, General Motors; those both have PE ratios of less than 10. So it's kind of a double-edged sword here, where the lower the PE ratio, the actual more at current levels, the more value you're getting. But like I said, it's indicative of the market saying we don't like the future prospects of this company. Whereas the higher PE ratio, you're getting less value at current levels, but it's the market's way of saying we really like the future prospects for this company. So an example I have here, a PE ratio of 5 means you're paying $5 for every $1 in earnings. So basically, if those earnings remain constant, your $5 investment will be recovered in 5 years, because you'll earn $1 per year, or the company will earn $1 per year. So you're essentially getting a 20% return on a PE ratio of 5, which is obviously a tremendous return that everybody would jump in. But the reason that the PE ratio is 5 is because the market does not expect those earnings to remain constant. It expects those earnings to decline, and thus it will take you long. It will expect earnings to decline, even if the price stayed the same and earnings decline over time. Your PE ratio will then get higher, and essentially you get less of that 20% return will turn into a lot lower amount. Now, on the good side, if you take the gamble on the lower PE ratios and they turn their company around, or for whatever reason they don't decline at the rate that the market thinks they will, you can end up getting some really good returns in there. On the flip side, if you go with the higher PE ratio and they outperform the growth that the market expects, you can get good returns there. And then research what the PE ratio has historically been for the company versus current. That's also important. Different industries get valued differently. Utilities typically have a lower PE ratio because they're a highly regulated industry, so the market doesn't expect great growth in that industry. So those typically, will be somewhere in like the 15 PE ratio. So if you see a company in there that's trading at 13, don't necessarily think it's a low PE ratio. Make sure you're comparing PE ratio to the company itself and also the industry that it's in. And then number one, decide if you really want to buy individual stocks. So like I said, in the long term, passive investing, if you look up this, if you Google Warren Buffett bet, a bet that just ended, it was a 10-year bet, started in 2007, just ended recently, 2017, where he put his money in Vanguard funds, passive funds, and challenged, or a hedge fund, an actively managed hedge fund, challenged him that they could out-return him over that 10-year period. He won by a landslide. So it is very difficult. The moral of the story there is it's very difficult to pick stocks. Whereas if you invest in the index funds, especially the broad range index funds, there are very specific ones out there. But if you focus on the broad range index funds, you're really just kind of you got your hand in the game. You're not necessarily latching on to one specific horse, but you're in the race. And picking individual stocks takes time. It takes time to research. All the things that we just outlined. It does take time to look through the financials, figure all that out. Try to understand why a PE ratio is high, why a PE ratio is low. Is it a great buy, or is the market telling you something? And then you get into the point of market timing. So the third point there, are you going to buy and sell when you think it's the right time? Are you going to hold the individual stock forever? Generally speaking, historically speaking, investors suck at market timing. We panic when the market plummets and we sell our stocks, and we get really excited in times like these when the market's up every day, and we typically buy, and then the top comes in, and it starts to decline, and we panic, and that's kind of how the way that the typical investor mindset works, and historically what we see from individual investors. So it is something for you to decide. Like I said, for me personally, the answer is have the index funds in my 401k, in my IRAs, and just let those go, and then take some extra money, and because I have a passion for looking at investments and looking at companies, take that extra money and put that into use there. But like I said, having that base of index funds, I think is very important. So again, hope you learned something. Comment below if I missed anything, if there's anything else you want me to add, and stay tuned.